Thanks, Steve, and thanks, Michael, and thank you to the Economic Society and everybody for coming. I hate leaving things incorrectly floating in the air, but the A380 is made by Airbus. Yes, seat 13A, to be precise. So what I wanted to do today is obviously oversimplify a very complex situation in the global economy. But I just wanted to sort of lay out the way that I'm thinking the world works and where things are heading. So what I wanted to do is I think a lot of people, when they start thinking about the global economy, think that you're starting today. There's just something happening today. And the issue is not the short term. The actual problem we need to put is a contextual framework around the way to think about this. And there's been a lot of things happening in the global economy over the last few decades which are fundamentally transformational. And what we're observing, I think, is the impact of a major structural change, primarily coming from the emergence of China and India and Brazil and the large emerging economies into the global economy. Billions of workers with very low skills entering the global workplace. That being misunderstood as a shift in aggregate demand in various economies and therefore completely misdiagnosed problem met by very bad macroeconomic policies. So the context is to get the last several decades of where we've been coming from before we can understand where we are. Once I get to where we are, we can look forward, and there's the issues of what's going to happen to growth in the world economy, what's going to happen to the euro. My view is that one of the most serious risks we face are the fiscal risks, both the problems of debt that we've seen and that Steve talked about, but also about some of the policies that have been proposed to deal with that large stock of debt. I want to talk about something that most people don't think is a problem, but I think is a very serious problem, and that is looking at 5 to 10 years, the inflationary risks the world economy faces. I want to talk a little bit about commodity prices because all these global factors all impact Australia directly, but they also impact us through what's likely to happen to commodity prices, and it's worth pointing out that this commodity price boom is not permanent. And then talk a little bit about implications for Australia. So the context of where we're at right now is really on a very beginning path towards a major change in the global economy. We've got China and India through big reforms in China, smaller but nonetheless substantial reforms in India. And this has really fundamentally changed relative prices. The relative prices of manufactured goods, particularly low-skilled manufactured goods, relative to primary resources, relative to food, etc. And these changes from India and China aren't just on the production side, these are also changes coming about because of changes in consumption patterns. So as we look forward, we're going to see massive shifts in relative prices because of the consumption patterns of low-income households becoming middle and high-income households. In addition to the sort of what you might regard as fairly standard international trade issues, you've also had a fundamental shift in savings and investment balances around the world. And so we've had China saving very large parts, more than 50% of GDP. And even though investment rates are very high, that excess savings has been spilling over into the global economy, and that's been changing real interest rates and has been changing the rates of interest that countries can borrow to finance their own domestic activities, and has probably led to a fairly serious misallocation of investment in the global economy. Now, these structural shocks, I think, have been interpreted as insufficient demand. So we've got a series of these crises. We can go back to 97, 98. We can then look at the dot-com bubble bursting in 2001. We can then look at the global financial crisis, as it's referred to, in 2008. But each one of these shocks, to me, was really just the tensions within the domestic economy. In the US, for example, Detroit and automobile production ran straight into the problem of an emerging automobile industry in developing countries. Those industries should have restructured or at least disappeared, and they didn't. And countries and the US government was pouring money into activities to try and keep white males employed in manufacturing. And you see that whether it's in the auto industry in the US, whether it's in the building industry. So the sort of decisions that were made to try and keep aggregate demand going didn't deal with this fundamental structural shock. Now, there was a demand deficiency in these economies as well. I'm not saying it was all one or the other, but I think the two were not understood to be factors that needed to be accommodated. So in 2001, the response in the US, the recession, the followed the dot-com bubble bursting was just a flooding the economy with money, and interest rates fell to 1%, which was seen to be rather low and temporary, but this led to a fairly substantial misallocation of capital, and that came home to roost in the financial crisis. The US bubble was going to burst in 2008. The only question was what was going to be the trigger, and there were a number of triggers and deficiencies. But yet again, the US government thought that it was just an insufficient demand problem. It was just a Keynesian problem. Let's just stimulate the economy and flood it with money and the problem will go away. And in fact, in Australia, we have exactly the same set of problems here. We could be selling absolutely no iron ore. Suppose we had no resources in the ground. We would still face the same relative price shock as we face with the resources in the ground. That is, there are certain industries in this country, given the reality of the global situation, that aren't productive or aren't competitive at any exchange rate. So we would be restructuring our auto industry, we'd be restructuring low-skilled manufacturing, independently of whether or not there would be in this massive terms of trade shock. As it turns out, we're lucky that China wants to buy what we sell and temporarily is giving us the resources to pay for the restructuring. Now, unfortunately, we're not paying for the restructuring. We're actually just blowing this in cash handouts and short-term reallocation of a boom when we should be investing in these big structural issues in the global economy. But I'll come back to that in a minute. So where we stand right now is, again, we're in a situation where these structural pressures haven't been allowed to emerge in the advanced economies, and we're running into this problem that we have a very serious global crisis, particularly in Europe, but it will be coming in the US in the next episode once people realise that the US fiscal situation is completely unsustainable. And again, we've built these debts up because we're trying to fight aggregate demand deficiency rather than paying for structural change. So when we look forward, I mean, you can be very optimistic actually at a global level because the world is transforming where billions of poor people are becoming richer. And that's got to be a good thing for everybody. The only question is how that will be distributed globally. So if you're looking out over the next long-term 50 to 100 years, it's going to be the big drivers in trends that are going to be dominant. And these are, as I mentioned, the emergence of the BRICS. These are the big demographic shifts. There's enormous demographic transformation going on within countries and across countries. You've got the Japans of the world whose labour force is shrinking and population is shrinking. You've got some of that phenomena in Italy and parts of Europe. You've got a massive demographic bubble coming through India, which means India is going to transform itself relative to China, where China has a demographic problem more like Japan's than like India. So you have all these demographic shifts. You've got enormous productivity and technological innovation to be expected because there's a lot of technology that hasn't even entered into a lot of these large emerging economies. Things we already know about how to do things efficiently. And once we penetrate these economies with greater efficiency improvements, that's going to drive wealth creation, and that wealth creation is good for the whole world. But there's also a lot of future technical innovation. So if you're trying to predict where the world will be in 2050, it's almost impossible, unless you're in Treasury and you're doing revenue projections. But it's really a difficult thing. And so the whole issue of how do we predict the future is about understanding the scenarios that are out there and all the sensitivities in your assumptions and how really uncertain the world really is. And the final issue, which is becoming increasingly important and I think will drive a lot of adjustment, is both the impact of environmental degradation, whether it be local or regional or global like climate change, how that impacts on the economies, but just as importantly and probably more importantly, how the policies that governments put in place to deal with these either real or perceived problems, how that then impacts on economic development in a lot of these countries. So this environmental wave of where adjustment is necessary is also going to have some pretty big impacts. So that's sort of the big picture, and that's actually a very good news story that the world is actually moving ahead in a very positive way, and a lot of poor people are becoming richer, and a lot more is being spent on dealing with some of these problems, such as environmental problems. But in the short term, one can be very pessimistic. So if you look at growth will be the first issue I'll touch upon, economic growth at the world level. If you look at this chart, this is an IMF World Economic Outlook chart, and the blue lines are economic growth on average for the world, and the pink maroon lines, red lines are the forecasts, which are obviously no longer probably relevant. But if you see where the global financial crisis is in this chart, it's that little blip down in 2008. So even though if you're in Europe or America, you would have thought this was the end of the world, it wasn't the end of the world, it was the end of your world. But actually, developing countries grew through the financial crisis, and because developing countries make up 50% of the world economy, the growth that we see, this small, less than 1% decline in economic activity, is purely dominated by the industrial countries. And so the world continues to grow through these crises, even though when you look at the news or you hear the prognosis from policymakers, you would think that we're living in really, really ugly times. And the forecast for growth is actually remarkably strong, although by now, 2012, you'd have to be downgrading below 3%, I would have thought. But still, the IMF is nonetheless still optimistic. So the issue is not the aggregate growth at the world level. The issue is how it's distributed. And this is a graph of industrial production. And this is for countries that are members of the Eurozone. And the chart on the left is industrial production in Germany and France. And the chart on the right is industrial production in Italy, Portugal, Greece and Spain. And what you can see from this chart is a number of things. Firstly, before the crisis occurred, Germany was growing very, very strongly. And the reason Germany was growing very, very strongly was because the rest of Europe was growing reasonably weakly, and this kept the euro quite weak, and this, because Germany is a major exporter of capital goods, this stimulated the German exports, and Germany did very well out of a common currency because they had, on average, a very competitive economy. If you put this together with the input costs, the increases in efficiency of labour, Germany was becoming ultra competitive, and part of this was because of the euro. Now, when the crisis occurred, you can see some very large collapses everywhere, particularly in southern Europe. So if you look at Italy, Italy's production fell by close to 30%. So this is the Great Depression in these economies, in Greece, in Spain, in Italy, and Portugal. These economies went through a very, very serious shock. Now, what's interesting from this chart then is that in the rebound occurs largely in Germany and France. It doesn't occur in these other economies, primarily because to recover from this sort of economic crisis, what normally happens is you need an improvement in competitiveness. You usually get that, as we did in Australia, from a big depreciation of your real exchange rate. Your exports surge, that drags the rest of the economy along, and on you go, recovering from this sort of crisis. What's happened in Europe is we had the recovery in Germany, but because of the single currency, because of the euro, you couldn't get the competitiveness bounce in the southern European economies, and you've run into a very serious economic crisis in these economies. I'll come back to this in a minute. It leads quite naturally into the question of what's going to happen with the euro. Well, I actually, and many economists have written on this, but we published a number of papers in the early 90s about how the euro can't work. And all you needed in the euro zone was a shock which was asymmetric. Whether it was an asymmetric demand shock or an asymmetric risk shock or an asymmetric supply shock, anything that would need relative price adjustment, as soon as that relative price adjustment wasn't able to occur, you were going to drive the inefficient economies into a very deep hole. And there's three basic problems. I mean, there are many problems in Europe, but the three main ones is you need about a 30 or 40% depreciation of the southern European economies to make them competitive so they can grow again. So even if you write off all their debt, and I'll come to the debt issues in a minute, even if you write off all their debt, if you're not growing, then you've not solved any of your problem. You've got to grow out of the crisis. The second issue is the fiscal position is completely unsustainable, and I'll talk about that in a minute, that these countries are now running debt-to-GDP ratios which are just completely unsustainable. And so you've got to write off the debt and you've got to devalue your exchange rate. But it's actually more complicated than that because most banks in Europe are actually insolvent. So the banks are holding on their balance sheets government debt, and the governments themselves are insolvent, so the banks are insolvent. And a lot of the policies you see where people are shuffling, in Ireland, for example, you've taken a private sector banking crisis, you've nationalised it because you didn't want the German banks to fail because that would bring down the European financial system. So it's now the Irish taxpayers that have to pick up the bill. But each country's got their own set of problems. In Greece, you've got the government is actually over-borrowed. In Spain, debt to GDP is about 70% of GDP from the government's point of view, but the private sector is so highly leveraged that the government's going to have to take over the private debts, in which case you end up turning, in Spain, what is a private sector crisis into a sovereign risk crisis. So the whole system is completely unsustainable, and it's accumulating on itself because you're not dealing with the fundamental problem. These things accumulate exponentially. So to deal with the problems in Europe, you need to deal with these three sets of issues at least. And the trouble is all the focus has been on the middle one. So let's just see what this is doing to to Europe. This is actually also, this is a little bit out of date now, but notice this is the spreads between 2-year bonds, government bonds in each of the economies on the left relative to the German Bund, and on the right is in Greece. Now, some of these actually aren't real data because some of these, especially the Greek debt, just went through infinity, and it's hard to plot that on a chart. So the problem here is, if you look at this, these countries are paying, Greece is 18,000 basis points above the Bund. This is not what a common currency would look like, right? So pretty clearly, the risks that's priced in here suggests that this thing has to blow. You can't survive at these risk spreads, because when you have debts to GDP ratios of some of these economies, anything above a zero interest rate is devastating. And we're talking here about 6 or 7% interest rates in these countries, even when the basic rate in Europe is under 2%. So this takes me to the fiscal risks, and the fiscal risks are real, and the fiscal risks derive partly from the euro itself, but also partly from a misunderstanding of the role of fiscal policy. These are the deficits to GDP ratios in OECD economies, and you can see, leading up to 2008, countries in Europe and the US and Japan and OECD average was about 2% budget deficits, between 2 and 3% of GDP. Now, this is a time when the world economy is growing very strongly. These countries all should have been running surpluses at this point. So they're accumulating debts during a period of economic prosperity, and then when we get the crisis, we get massive shifts in fiscal policy. So if you look at the UK, for example, their budget fell, they went into 11% deficit in 1 year, 11% of GDP. That is more than 10% of the economy is now just been scooped up by the government in terms of resources available for private investment. And these deficits, although you could argue that there's a case for fiscal response to the sort of demand shock we observed, these deficits don't go away very quickly. And so you have a situation which converts these deficits into stock of debt. And this is where the crisis is, actually. It's not in the deficits, it's in how much debt there is in the world economy. If you look at this chart, you can see that what's interesting from a historical perspective is that the previous debt crises have always been a crisis of developing countries. They accumulate too much debt, people lose confidence, they mismanage the economy, and there's an economic crisis. This time around, though, it's the emerging and developing countries who are actually running very responsible fiscal policy, and it's the advanced economies that have got their debt to GDP ratio over 100%. So 100% debt to GDP ratio, that means that if the normal interest rate was, say, 5%, the government has to put aside 5% of everything produced in the economy just to service the debt. So once you get above 60% of debt to GDP, many economists suggest that you're running into serious problems. Now, that's very simplified, because it really does matter what you use the debt for. So you could quite possibly be borrowing 100% debt to GDP at 5% and getting a 25% rate of return on that, and that's a perfectly legitimate and sensible thing to do. But a lot of this debt run-up hasn't been to provide infrastructure or public investment or human capital. It's basically to maintain levels of consumption or to support industries that are not supportable. And we've suffered the same sort of problems in Australia, where we should be running deficits, and we should be using that to invest in infrastructure and high return activities. But instead, what we do is we run deficits and we recycle the money as cash handouts to be spent as consumption. So we are subject to the same mistakes as the rest of the world is making, the advanced world. It's just that we're lucky that the Chinese are pouring vast sums of money into this economy, so we can afford to screw up on a regular basis. Now, this is a real problem for the world economy, because if you look at, and again, this is gross debt to GDP, and there's a debate about whether you should use net or gross, but this is gross debt to GDP. And what this chart shows from the OECD is something extremely interesting. This is all the OECD economies. It's fairly obvious, I think, what the countries are along the bottom. And the light purple is the debt that that a country started with in 2007. And then the blue line is what the debt increase was forecast to be by the end of 2012. Most of it is actual, but there's a little bit of forecast. So if you look to the left, we've got Japan running a debt to GDP ratio over 200%. So a fair chunk of that was already in the system, about 170% debt to GDP ratio, but some of it was in response to the crisis. You can see each one of these countries has a different story to tell. If you look along to the fourth country, Ireland, you can see that they were incredibly sustainable at about 40% debt to GDP ratio. but because one finance minister made one mistake and promised to bail out the banking sector in Ireland, this turned from a private sector banking crisis into a sovereign risk crisis and blew the debt-to-GDP ratio above 100%. And so we can see that the Irish story is different, and then the Icelandic story next to that is different again. And you can run all the way along, and you can see that Australia is at the very end. So Australia's debt-to-GDP ratio here probably sits at around 28% gross debt-to-GDP. We don't have a fiscal crisis, a debt crisis in this country. We don't even have a debt sustainability problem in this country. We probably have a problem that the debt hasn't been very well invested and been wasted, but that's different to an issue of sustainability, and that should be driving partly our policy response. So anyway, it's really quite interesting. The question then is, well, where is the line here that gives us a bit more stability in the global economy? And you can see that probably 80% of these countries, which is a fairly large chunk of world GDP, are above the 60% debt to GDP threshold. So what needs to be done between now and some point in the future where the fiscal risks are reduced is a very, very large adjustment. And this is from a study that I did for the G20 last year as part of the Shadow G20 group that Jeffrey Sachs runs, looking at how much do you need to adjust. And if you look at the swing around in the budget deficits for Japan, Japan has to turn around their budget position by 9% of GDP between now and 2020 to stabilise debt at 60% of GDP in 2025. So if you use that sort of benchmark, you can see that the fiscal adjustment that's required in many of these economies is a very, very large fiscal adjustment. So we're talking about, in Australia, the Prime Minister, the Treasurer has talked about the biggest fiscal turnaround in Australia's history, if you believe the budget, and it's around 4% of GDP in 1 year. Some of these countries have to do 2 or 3 times or more than that. So the question then is, how does this impact on the global economy? If you try and do this, what happens? Now, I don't think I've got... No, I haven't got the results here because I didn't think I'd better use any equations in case there weren't any... there were just academics in the audience that would appreciate it. But what we did then in this study, which is on my website, was we said, suppose you do this in the global economy and you have a model of the world economy, what happens? And it turns out if you do it very, very quickly, you create a really serious recession. If you do it gradually over time, where you cut more next year than this year, but it's absolutely credible, you can actually, you still get a recession in the countries on the left, you get an economic slowdown in the others, but in fact, you get back to a sustainable position at a very, very low economic cost, but it takes more than a decade to do it. So what's required, if you're serious, is a very clear, gradual, credible fiscal consolidation, which we probably wouldn't see just because of the politics of the situation. But there is an economic argument to do a fiscal consolidation, but not the slash and burn that is being advocated. So this comes to inflation, and it seems rather odd to talk about inflation because most people would think that the biggest risk we face is deflation. People look at Japan, they see the lost decade, 2 decades now, and they see that the consequences of the big bubble burst in the real estate market and the collapse of the financial system was asset price deflation and goods price deflation. Now, it's quite different, I think, in the current environment because of what central banks are actually doing. And this just gives you an illustration of just how dramatically different the world is today than it used to be in the mid-2000s. This is the balance sheet of the Fed, and the balance sheet of the Fed used to be about $500 billion. During the crisis, the Fed decided that they should start buying up assets, and they were buying up treasuries, buying up agency debt, that's Fannie Mae and Freddie Mac, mortgage-backed securities. And you can see that there's been these waves of buying. QE1 in 2009, QE2 in 2010, QE2 in 2011. Probably, most likely, there'll be a QE3 in the US once it starts slowing, because the growth in the US at the moment I don't think is sustainable growth. It's sort of recovery from a recession plus a little bit of reallocation of capital from Europe. But we see that the Fed balance sheet is totally blown out. Now, the problem for the Fed, or the advantage for the Fed, is that this incredible increase in the money supply hasn't actually ended up in any inflation because the demand for money has gone up at the same rate. So people, rather than investing in a whole bunch of activities like building things, they're just holding money. And so the demand for money has gone up at the same rate as the supply for money. But if we ever restore confidence, the Fed has a dilemma of how to contract the money supply fast enough so that you don't end up with very serious inflation. And in the end, my prediction is that the Fed will end up having high inflation because there's three ways to fix the US budget deficit. One is raise taxes, and that's ruled out by the Republicans. The second is to cut spending, and that's ruled out by the Democrats. And the third way is, thank God the world is holding American debt in American dollars because you just have a bit of inflation and then you can tax foreigners. And the foreigners aren't actually represented in the US Congress, whereas the Democrats and the Republicans are. So it's pretty likely that the incentives facing the Fed in the end is to inflate this stuff because that's the only way you can get the US debt-to-GDP ratio to be sustainable. Now, how is this showing up? And I think it's actually quite interesting because when we put all these factors in our models, even though the US is going through a recession and flooding its economy with money, it doesn't mean that it's not having any impact on the rest of the world, because there are a lot of countries like China and parts of Latin America and Asia that are pegging to the US dollar. So as the Americans flood the economy with US dollars, to prevent their currencies from rising relative to the US dollar, China and India and other countries flood their own economies with money, and that causes their exchange rates to stay relatively pegged to the US dollar. What that means then is that they're pushing excess demand into their own economies. And these charts, you can see this very clearly if you look at base metals or Tapis oil. You have in there, before 2007, some real demand factors. China's growing, India's growing, Brazil's growing. They're buying a lot of resources, so the demand for resources is going up. But on top of that, you've got the classic inflation shocks that we observed in the 1970s, where there's excess demand in these economies, which means this phenomena of these relative price movements are actually both 1970s style inflation and a shift in the world economy coming about because of the fundamental emergence of China and India. So to disentangle that earlier period is pretty hard. We've done that in some modelling that I think the RBA published a few years ago, and about a third of the run-up in commodity prices pre-2007 we can put down to this China-India effect. About a third we can put down to the US monetary policy, very loose monetary policy from 2001 to 2007. And about a third we put down to speculation because we can't explain it with our models. So we'll call that speculation. But anyway, so you can... Now, the latter period, though, is... And again, crisis occurs, these markets collapse. You would have thought that commodity prices, particularly oil, would have gone back to where it was at, $20 a barrel, but actually it's hung up there around $100 a barrel. And that's reflecting, I think, really China and India demand, but it's also reflecting this idea that the US is still flooding the global economy with money, and that's going to be inflationary. The transmission is different this time around because this time around, in my view, what's going to happen is the excess demand in developing countries is going to be driving up energy prices, food prices. They're imported back into the US economy and back into the European economy, and that's going to drive up prices in those economies. And so the inflation won't be necessarily domestically driven through wage adjustment, although ultimately wages will need to respond to keep that inflationary impulse in these economies, but the trigger will be energy prices and food prices, etc. And so we've just changed the transmission mechanism because of the way the global economy is configured and the scale of the non-US and non-European part of the world economy today. So if we look at where inflation is going, you can see that in Japan we have that period where there was a long period of deflation. Actually, Japanese inflation is now positive as a result. This is a little bit out of date. As a result of the rebuilding from the Fukushima and tsunami, Japan inflation is now positive. But if you look at inflation in the US and Europe, you can see that inflation, core inflation is unnervingly high, and headline inflation is even higher. And you particularly see this in China and India. And the latest Indian data has just come out and it's probably back up above 8%. And so we have this problem that we have an inflationary impulse in developing countries. The only question is, will it come into the industrial countries? And my view is yes, it will. And we can see countries, particularly in Southeast Asia, already feeling quite high inflation. And these are the short-term policy rates. And what's interesting is they are changing policy. They've been tightening policy over the last few years, but the real interest rates are still negative in many of these economies. So these economies are still following expansionary monetary policy because they're worried about losing competitiveness relative to China because China's pegging to the US dollar. So that brings me close to the end. The question then is, well, what's going to happen to commodity prices? And it's interesting to try and disentangle what's driving this commodity price boom. It's a very impressive boom. And as I mentioned, part of it is real. Part of it is because China and India are emerging into the global economy, and the structure of their growth is such that they're very energy and commodity intensive. And they will continue to be for some period of time. So you add that to this very, very loose monetary policy driving through fixed exchange rates, excessively loose monetary policy in these economies that are booming, and you've got two factors driving up commodity prices. Now, what matters though for Australia is not the commodity prices per se, it's the commodity prices relative to what we consume, because the terms of trade is the price of our exports relative to our imports. And there's no doubt in all previous commodity cycles that the supply response eventually occurs. So if the price of iron ore remains at record highs for very long, there's going to be a lot of investment in producing iron ore, which there has been, and the only thing that prevented it from happening more quickly is that it's very capital intensive, and we had the financial crisis in 2008, dried up capital markets and slowed down the process. But we're right now in the middle of a massive commodity response. So over the next few years, there's an enormous increase in the supply of the stuff that we sell coming out of the ground, not just from Brazil, but also from Africa and from China itself. So there will be a supply response. Now, what that means is we're still going to be better off. We're still going to be selling a lot more stuff. It's just that we're going to be selling quantities and we're not going to be getting these excess prices, which is pure profit. And so the global supply response is seriously happening. China is slowing down. My view is that there's three problems in China. One is that the European slowdown is impacting on Chinese exports. The second problem is that that very high oil price is impacting on China because China is very energy intensive, and even though they produce a lot of their own energy, they're still pricing at world prices. And the third is that they did try and take the bubble out of the asset markets by tightening policy, and they're getting the growth slowdown that they want. And my view is also that they have fairly good control, so even though growth probably will come back to 8% or 7.5%, that's actually sitting at potential. China's been growing too fast for too long relative to what our models predict, and so this is actually a good outcome, but China is now starting to relax policy to free up liquidity in the economy. So even if China doesn't disappear, I think our commodity price cycle is already adjusting because of the supply response. And the final point is that, again, because we import a lot of manufactures and we import a lot of stuff that are non-commodities, because of this global inflation shock, which I think is going to start to emerge over the next few years, the price of what we import is going to be rising relative to what we sell anyway. So the relative commodity prices will work against us. So overall, we'd have to be in our planning assuming that our terms of trade will come down and that we shouldn't be building into any of our budgetary expenditures the assumption that we've got this perpetual revenue stream. Now, just to come back to a point I want to stress, if you look at this chart, this is actually from the RBA website. If you look at manufacturing was around 15% of GDP in 1990, and you can see this trend decline in manufacturing share as a share of the economy. So this is not the exchange rate that's doing this. This is the fact that China and India and other developing countries are penetrating the markets in which we were trying to compete, and we are no longer competitive. So our economy, by being part of a global economy, is inevitably moving in a particular direction. So whether we had iron ore or not is not the point. Having iron ore means that we've at least temporarily got some funding we can use to deal with this adjustment issue. Trying to reverse that by just fixing the exchange rate, or trying to reverse this by heavy subsidies in manufacturing, isn't going to fix the problem. And so that's the first point I think it's worth stressing, that you can see the impacts of the exchange rate towards the end of this, but really this process is bigger than just the exchange rate. The second issue is that people think that Australia doesn't have an inflation problem. It is true that consumer price inflation is back. This is actually out of date now because we know the new data is close to 2%. But if you look at the breakdown, you can see that this inflation is largely driven by non-tradable goods. So these are the goods in the economy that are really driven by demand in the domestic economy. Imported inflation is actually detracting from the inflation rate because the price of imports is falling. So when you combine the two, our average inflation rate is around 2%. The thing that the Reserve Bank should be worried about and is worried about is not what the aggregate price inflation looks like, but what the non-tradable price inflation looks like. So we still have in this economy a lot of strong demand independently of some of the sectoral problems that we observe. So let me just conclude so there's time for questions. The context in which we're trying to, or which policymakers are trying to operate, has to take into account what's happening in China and India. That's one of the key drivers, and it's a big structural shock. And all of our policy focus should have been in the budget, should have been in last year's budget, it should be in all future budgets, is how do you deal with the structural adjustment that we're inevitably going to face. So it's not a question of the exchange rate, it's a question of these shifts in relative prices, which the exchange rate actually accentuates or can offset but doesn't eliminate. And again, I think most countries have misunderstood what's going on and seeing what's happening in their economies, particularly in the US, because the rest of the world doesn't really matter, that what they're observing is a domestic issue, not an international issue. And therefore their policies, I think, have just not focused on these longer term issues. It's important in formulating policy to have a better handle on whether we're observing in these, particularly in the oil prices and the food prices, are we observing a shift in real demand relative to supply, or are we observing the beginning of a big inflationary shock like we observed in the early 70s? And remember, the early 70s shock wasn't just that oil prices jumped. The early 70s shock was that in the late 60s, the US financed the Vietnam War by printing money. And because of the exchange rate system that we had in place, the whole world was flooded with cash. And that drove demand, and therefore OPEC was able to get a price increase that otherwise wouldn't have been possible. So there is definitely a monetary driver to the inflation of the early 70s, which I guess is still here now. The commodity price thing, again, I'll just re-stress that our terms of trade won't be as high as they are now for a very long period of time. But the emergence of China, even though we will mature and our terms of trade will come down, the emergence of China is undoubtedly a good thing for the world economy. If China becomes wealthier, if India becomes wealthier, the whole world becomes wealthier. And so then there's this issue of how do you deal with this redistribution of wealth, and an open trading system is key. If you close down world trade, if you close down global capital markets, then it's going to be much harder for the industrial countries to benefit from the surge in wealth in the developing countries. And I think that's an important lesson that a lot of policymakers seem to be arguing for completely the wrong policy with regards to poor countries becoming wealthier. Thank you. I think I had another slide, which is my website, but it apparently isn't there, so apologies.
Please stay. Well, now's your chance for questions, or to take it to the upstart, Mr. McKibbin, and compare your models. If you have any questions, please put your hand up down the front.
In World War II, the U.S. debt-to-GDP ratio was 120%, roughly about 20% more than it is right now. Why not? Okay. Roughly about 20% more than it is now.
Yeah.
According to work by Carmen Reinhart, financial repression basically took care of around, let's say, 50 to 55% of bringing that debt down and spreading the burden across the country as well as across time. Of course, this works when debt's denominated in your own currency.
Yeah.
So the issue is, why didn't you mention financial repression? And does your forecast for inflation undermine the key strategy, which is basically you need to keep interest rates below the inflation rate, and the banks have to be required to lend a certain percentage, let's say 30%, to the government to buy their debt?
So the only way you're going to get away with the financial repression is if you completely regulate the financial system. You have to intervene heavily. And maybe that could happen because it has worked historically. Although, again, after the Second World War, there was a massive surge in productivity as well, which helped run the debt down as well. So it was a combination of factors. It's unlikely we're going to see that surge in productivity now because there's no war that the US has just fought well, the war on terror, but I don't think there was a lot of productivity gains from that. But on the financial repression, yeah, it's possible, and countries may well completely re-regulate their financial systems. I think that the problem with that is that it really does distort capital allocation for a very long period of time. It's probably a very bad policy move, as it was and has been in a lot of developing countries. They've discovered that liberalising the financial markets with good regulatory frameworks gives you a much better payoff than, basically not paying savers for their savings. But I take the point. It's a fair point. It's a possibility.
Table number 9.
Yeah. John Quiggin. So I like nearly all of this, but I suppose following up from the previous speaker, your opening slide, you refer to several decades. Well, clearly a China-India explanation works for the last 10 years or so, but not for several decades. We can go back to 1996 when Greenspan was talking about irrational exuberance at a time when China and India, in quantitative terms, were tiny in the world economy. And so it does seem to me you haven't mentioned the financial sector as an explanation, but it's the elephant in the room that hasn't appeared here. It's the growth of the financial sector which really has driven nearly all the developments you describe in the Eurozone and has sustained this unsustainable growth in debt.
Well, I mean, let's go back. I think actually that's not... I'm not explaining the global financial crisis here, right, John? What I'm doing here is saying, what do I think are the big drivers? But secondly, the relative price shifts that we're talking about go all the way back to the debates in the US in the 80s. Why was it? Was it productivity growth in the US, or was it the emergence of developing countries in global trading systems that were driving relative wages in the US, the wage distribution arguments? And I think the evidence there was quite a fair bit of that was actually coming through the trade channel, and some of it was coming through domestic national productivity. So you can see back in the 80s the beginning of this, but it was pretty small. It was the 90s when things really started to move. Now, it is true that with the financial deregulation and some of the incentives that were put in the financial system, you perpetrated some fairly bad investment decisions and you accentuated the adjustment process in a bad way. So, if you didn't have that sort of misallocation of capital coming through the financial deregulation in the way it was done, you'd still have a problem, but it'd be a different problem, in my view, but it would still be there, that the countries haven't adapted. But the financial systems need a serious reassessment, and I don't think that just bailing out the banks, as they're doing in Europe, fixes any of the incentives or any of the problems. But I think fundamentally it's the real drivers that were pushing on these imperfections that caused these imperfections to lead to such catastrophic outcomes for some countries.
Table number 12.
Mark McGovern, QUT. In 2007, when Rick Ballatino from the Reserve Bank warned of the badly mismatched balance sheets of the Australian households, and also we had a Senate inquiry saying that over half of households invested without considering risk and return but thought they were good investors. The Reserve Bank's position at that point, did anything really change? And given especially the amount of carry trade currency that was coming into the country and the increasing borrowings of banks overseas, I mean, we've got a monetary issue here which seems to have gone neglected. Your thoughts be welcome, thanks.
So, I mean, I was sitting on the board from 2001, so I was there during that period, and I can't talk about what actually happened on the board, but the sort of debates that were going on was there'd been a lot of wealth generation, right? And the question was potentially if there was a new world order, Australia's potential wealth would be enormously larger than it was, and was it normal for households to borrow against very high expected future income? So, and there was also some financial rigidities that were freed up in the earlier decade, and so the question was, what was the optimal level of leverage to get the consumption smoothing logic to be of greatest benefit to the Australian people? And the answer, we never got an answer to that. It was probably higher than it was. The amount of leverage was probably optimally higher than it was back in the 80s for sure. But the question is, have we overshot or not overshot? And I think the question is still open on that. I think the inference from your question might be that is the housing market in Australia going to collapse? I mean, that's the obvious. We've over leveraged, but I don't see that the fundamentals suggest that's the case, because we have excess demand for housing. So.
It's not so much the housing market, the overseas exposure in terms of loan funds from overseas that you're using, that exposure to overseas financing of the Australian banking system.
Yeah, again, I mean, it's a tough one to answer until something goes wrong, and then you can do the present value calculation. If you can borrow at 2% overseas and you can invest at 5%, and you do that for a very long period of time, if in fact you get a crisis in the end and they turn off the borrowing, are you better or worse off? I think Australia is undoubtedly better off at this point. But you could also do the calculations in Greece or in some of these other economies and say that it was a big mistake. So it's not I don't know how to answer the question ex ante. My view is right now is there is an excess, probably an excess of leveraging given the global risk that we have. And you're seeing a lot of Australian households deleveraging as we speak, and that's why consumption is actually a lot weaker than you'd expect given everything else that's going on in the economy. So households are doing, I think, what they should be doing. The government is clearly deleveraging as well. My only concern there is that it should be more gradual, not as rapid, and we should focus on the quality of how that's done, not just the quantity. But yeah, when we're living in a very risky period, and so the whole issue of leveraging is actually quite complex.
Another question, I think Julian at the front here and all. Thanks, Tim.
You implied in your discussion about the euro that there was unsustainable pressures building up, and I infer from that you see the euro falling apart, at least some parts of it falling apart. How would that play out, and how catastrophic would that be, or would it be a sort of short, sharp shock and the world goes on and grows again?
Okay, so again, let's try and simplify this into three possible scenarios. One scenario is you keep the euro, right? Let's keep the euro. Now, the European Central Bank is targeting inflation around 2 to 3%, and if what we need in Southern Europe is a 40% real depreciation, then if Germany's willing to have 20% inflation so that the Southern Europeans can get away with, say, 10% deflation, it might just work. But if Germany wants 2% inflation and the ECB is targeting 2% inflation and you need this 40% depreciation, you need a 40% deflation in Southern Europe, and that's going to kill many of those economies. Secondly, if you have a fixed exchange rate and you do a fiscal contraction, standard simple macro, first year macro, Mundell Fleming says you contract fiscal policy to hold the exchange rate peg within Europe. You have to tighten monetary policy as well, so the output loss is actually accentuated. So we're asking these economies, if they're staying in the euro, to pursue policies which will basically blow up their economies given the scale of what's being asked of them. Even with writing off more than half of Greece's debt, they've still got a very large debt, and those fiscal contractions are severe. The second issue is you do nothing and the whole thing just spirals out of control, and that's chaos. And that's probably what's going to happen, just because it's too hard to imagine that it's not going to end up with unravelling the social... Already the political systems are unravelling, the societies are unravelling. Probably it'll be France that pulls the plug, not Greece, but these things are very hard to sustain when all you're sustaining is the principle of a single currency. The question is, well, why? The third thing you could do, and this is my favourite and has been for the last 3 or 4 years, is that you could take the euro, you could acknowledge the defects, you could split it into two currencies, you could have the ECB managing the Premier League and the First Division, and Germany and Northern Europe's in the Premier League, and Italy and the rest are in the First Division, at a 30% depreciation, and you then move on from there. Now, that's a nightmare for some people because some balance sheets are going to get blown up. It could still end up in chaos. How you would practically do it is like asking me, how would you practically dismantle the Soviet Union? Right? The fact is, well, I didn't have to work it out because it did it itself. Whatever evolves when something is unsustainable will evolve. But to pretend that you can hold this thing together, politically and economically and socially, I just think is in the big swing of history, we're going to look back at this and say, wow, why did they do that? But this is so. It seems to me that's the third option: is an attempted orderly dismantling, not of the entire euro, but let's get back to a place where countries can grow, and then start changing the institutional structures within these economies so that they look more like Germany, which is what they're going to have to do if they want to stay pegged to the German currency.
Another question from the floor, please. Yeah, John again. Sorry, table number 9, Tim. If you.
Yeah.
Do you see a breakup of the US dollar, and if not, why?
Well,
and it's the second point about the manufacturing story. I mean, if you took your graph back, 60% of the adjustment out of manufacturing in Australia occurred before your graph starts. We went from essentially an economy in which most people are employed in manufacturing or in selling the products of manufacturers, to one at the beginning of the graph where it's something like 15%. I guess I don't buy the story that the last tiny bit of the 100,000 or 200,000 people employed in the car industry is what's driving Australian policy at present. I mean, most people employed in manufacturing in Australia are making meat or aluminium, stuff that the Chinese want.
So just go back to the first question, which was, sorry, say it again.
Well, I'm just saying the same problem.
Oh yeah, for the US. Okay. So yeah, well no, it's not. It's totally different because you have very large fiscal transfers within the US economy. You've got the same sort of fiscal framework. You've got flexibility in the system to deal with people moving across borders, whereas in Europe, you've got too many rigidities. You can't get. You've also got very rigid labour markets in some of these economies. So you haven't got the price flexibility, you haven't got the fiscal support, and you haven't got the mobility of factors that you have in the US. Now, it is true that you probably, if you're in Michigan, you probably would like a 30 or 40% depreciation. And in fact, you're getting it in the asset values. You're just not getting it, and you're probably getting it in some other immobile factors of production. But you know, the US is if you look at the standards of optimal currency area, the US is much closer to an optimal currency area than the Europeans. And I think that's where they have a problem. The second issue is this one about how much of manufacturing is China and India. That's not the point. The point I'm making here is there's a big... Once the global system starts to integrate in this trade, comparative advantage becomes a key driver of what happens in your economy. Our comparative advantage wasn't low-skilled manufacturing from after the Second World War. And that's why our economy transformed the way it did. Now, what is our comparative advantage at the moment? It's probably fossil fuel intensive production, which we're pushing against because we're trying to follow a policy which I think is not the right way to deal with climate change. It's probably tourism, it's probably high human capital educational services, and it's agriculture and high technology agriculture and biotechnology. So that's our comparative advantage, and that should be allowed to blossom. And to me, the role of government is not to pick any industry like that. It's to create institutional structures and markets and mechanisms to let that evolve. It's not to say we cannot close down the car industry. We've got to have a shipbuilding industry because we haven't got a shipbuilding industry. We can't sustain a car industry. I find that sort of picking winners problematic, and it's just a waste of money in my view. Focus on the structural issues in the communities that will be affected and let the system move forward rather than try and prop up, for whatever reason, trying to push against comparative advantage.
Can I have whenever I come to these things, it's always the blokes who ask questions. I work for an equal opportunity employer. Is there a woman in the audience that would like to ask the question of Mr. McKibbin? Now's your chance. Any? Unbelievable.
There's one up there.
Oh, yes, thank you. At last. Table number 5. There's a microphone just in front of you. Thank you.
I am very interested in what you said about the impact of monetary expansion on inflation. And my issue is how you would model that, because we only have the example of the 70s and of the stagflation experience. Is that what you think could happen again? Like I see like the monetary expansion in the US flowing into emerging countries and not having an impact on food and energy and food prices, as you mentioned, and not flowing back to the developed countries. Is that the scenario you think would happen, and how would you model that kind of thing in a structural economic model?
Yeah, okay, good question. So in the US, the way I see things unfolding is that the demand for money is artificially high, and people are holding money because they don't trust, there's too much perceived risk and they're not investing. As soon as inflation, and so then we get the adjustment in developing countries, prices continue to rise, energy prices, food prices, that comes back into the US economy through imports, and because American goods are traded in global markets, you don't even have to import the price inflation, your prices will follow the world price. That impulse on inflation will cause people to reassess their desire to hold money, because you don't hold money if you expect there to be higher inflation. So as soon as inflationary expectations shift in the US, that's when the Fed has to be there ready to start pulling contracting their balance sheet. Now, whether the Fed would have the courage or the ability to contract the balance sheet at a time when the US economy is slowing again because of this problem with, this is going to end up in inflation, is the question. And it's feasible to do it. It's very hard to model it, but it's really getting the money supply to contract at the same time as the demand for money contracts. But it all hinges really on inflationary expectations in that sort of mechanism. And I think what's disconcerting is I've got a student who's doing a PhD on propagation of inflation globally, and one of the things that shows up in some of the inflation expectations work he's been doing is energy prices have a big impact on inflationary expectations in industrial countries. So if you see the price of petrol at the Bowser go up 10%, you tend to then assume that inflation generally is going up at 10%, and that's actually, to me, a very worrying sign from this high energy prices that we're observing. But it's hard, it's again, a lot of this stuff is built around expectations and the way people respond, as distinct from hard and fast equations. It's really, if you believe the world is going to hell in a handbasket and everyone believes it at the same time, the world will go to hell in a handbasket. And quite the opposite, if people believe that there's an optimistic scenario, then that can drive markets for quite a long period of time before the fundamentals kick in. And the expectations are part of the fundamentals, so it's quite complicated.
Thank you. I think there's one more down the back here. Yes, table 15. Thank you.
I'm Roseanne Barrett. I'm from full disclosure as well. I'm with the Australian newspaper. Can I ask about domestic issues? You said that in the budget and some previous policy areas the government had wasted money. Can I clarify, do you mean with the recent family tax benefit sort of handouts or changes there in the budget? And then you said the government should instead be investing that money in greater productivity gains. How should they be doing that, and across what sort of industries? Okay,
so again, in economics, productivity is not well understood, and there's a debate about what drives productivity. But in my view, flexibility is key, and people taking risks is key. You want people to innovate, and you want people and the way you get people to innovate is to let them keep some proportion of the rewards from their innovation. So you need to create a whole series of incentives so that you can encourage, through flexibility, people to take risks in the economy. To me, that's the key, and that's what's missing out of this budget. There's some good things in the budget, right? There's the invalid benefit system, probably underfunded, but nonetheless it's a beginning. But cash handouts do nothing except reduce the short-term problems that individuals might face in a budgetary sense. It certainly doesn't cause people to go out and invest in anything other than consumption, particularly when you allocate it to low-income individuals. What you should be doing is it's like fixing a famine, a famine in a developing country, and going in there and giving the people excess food. It looks good, but does it fix the problem? No, you should go in there and give them seed, and you should give them the incentive to grow their own food, and then you've got a sustainable solution. So to me, this Battler's budget is really, you could be cynical and say it's vote buying. You could also argue that that people are hurting and you need to do something about it. But to do something about it, I think you want to have a flexibility in the tax system as another aspect. And in fact, the one thing that's missing completely is this whole issue of the interaction of the welfare system and the tax system at the very low end of the distribution. Now, they have raised the lower end tax rates, which takes a little bit of that problem, but it just shifts it higher up the income distribution. So where's the Henry Review reforms on that interaction? Why should people on very low incomes pay an 80% tax rate, which is what you effectively have in some parts? So I just think it misses the opportunity. You could be very cynical and say it was all a political exercise. The final critique I have is, why would you, if you're trying to deal with the business cycle, why would you create a cycle by bringing forward a whole bunch of expenditure through cash handouts that will be spent? So you're going to spike up demand in the economy between now and probably August. Then you're going to pull out 4% of GDP over the next 12 months, and you're going to get this incredibly big impulse potentially, at the same time as the carbon tax is coming in on July 1st, which is also going to put a fairly big spike in the business cycle. How is the central bank supposed to respond to that? Do they cut rates? Do they raise rates? How do they monitor the data? So I think it's actually bad pro-cyclical fiscal policy, purely, from what I can tell, to get an accounting surplus in a particular year. And that's not a political comment, that's just bad fiscal policy.
That's political. Thanks, Rory. Brian, do you want to come up? Please thank Warwick McKibbin, please.